Hi, my name is George Dagnino. I'm the publisher of the Peter Dack portfolio. What I want to talk about again is the why people always talk about the Fed and not about the economy. I just cannot understand why there are so many big problems in the economy driving the markets, but yet people prefer, and I'm talking about the TV business channels, they like to talk about what Powell will do and will not do. But the markets are driven by the trillions of dollars of business decisions made by big any corporations, buying raw material prices, borrowing money to keep the business running, for capital investments, hiring people and firing people. There are tremendous demand from business, and these demands drive the markets. The Fed is just an observer, and they are trying to interact with the banking system so that the banking system eventually has an impact on what business should and should not do, if they can. This is the important thing. There are three parts in the model. There is the Federal Reserve, there is the banking system, and there is business. The Federal Reserve interacts with the banking system. The banking system is what they print money to help business grow, or not print money because they don't feel that business is doing well, so they stop lending or extending credit. This is the important thing. The Fed is just trying to, in a little way, to influence the banking system, but it's the banking system that decides, has the final word, if it is worth lending or extending credit, and therefore increasing the money supply and liquidity in the system so that business can grow. Let me show you the data. So I'm trying to convince you, because again, I'm really amazed how people concentrate on the wrong thing. I guess the thought that I have is that maybe it's too complicated to put together what business is doing, sales, in production, inventories. It's more difficult to keep track of all these factors. So it's easier to talk the Fed is raising or lowering interest rates, but the business is moving ahead, forgetting about what the business is doing. They are there to make money for their customers. Okay, this is what I was referring before. There are three parts: the Fed, the banking system, and the economy. The Fed is raising interest rates to make the cost of capital expensive for the banking system, so to discourage the banking system to lend to business, quote unquote, the economy there. Or otherwise, they lower interest rates so they make it easier for the banking system to borrow from the Fed so that they are encouraged to lend to the economy, to the business. Now, this flow of money, borrowing from the Fed and repaying the Fed and so on, is called M0. This is the basic monetary base. And this can be measured. I will show it to you how it measured. It is basically the reason why the stock market is going up, by the way, because there is a lot of liquidity in that loop, Fed banking system. But then there is another loop, and the other loop is banking system, the economy, that is the business. So if the banks see corporations not doing well, they are going to raising lending standards. So they are not going to extend credit, and they are not going to extend loans. That means that liquidity in the system is decreasing, and that's what the money growth of the money supply is all about, M2. But on the other hand, if they see that business needs an extra juice to keep growing because they're just ready to take off, then what the banks will do, they start lending money. But lending money means that the money supply increases, and that's where the markets and business start improving. So these two loops are very important. Right now, what the reason the markets are going up is because the loop M0, or the monetary base, there is a lot of liquidity in this loop. But on the other hand, there is less liquidity in this other loop because the banking system sees problems in the economy. Let me show you the data, because this is not just, science fiction. There are data to prove this point. Let me show you. This is the monetary base. This is the liquidity that flows from the Federal Reserve to the banking system. So the banks borrow from the Fed, or otherwise banks, when they don't lend or have an extra liquidity, they give it to the Fed for income. And of course, depending on the interest rates that the Federal Reserve is setting. So what you see, the measure of this liquidity is the red line. This is it. This is the red line. And as you can see, the market bottomed last fall, and the liquidity started growing because there was extra liquidity that the banks had in their books, and they were moving back and forth with the Federal Reserve. And this liquidity, eventually, this is the growth of the stock market, and you see that the stock market moved up. So this is one form of liquidity. This is why the markets are strong. Okay, and this is very important. Now this is the other loop. This is the loop, banking system, business, the economy. Okay, this is how the banking system sees the economy. And what the banking system is seeing, the economy not doing well. Why? Because if you look at the credit growth in loans, they're all really slowing down quite sharply. Obviously, it doesn't matter what the Fed interest rates rise or decline is, but if the banking system doesn't see an opportunity to make money, they're not going to lend money. And this is exactly what's happening. So what they do, they keep this extra money that they have between the Federal Reserve and the banking system. They don't release the money into the economy, thus increasing the money supply. So you see the two different sections of the monetary system. So what we see as investor, we see the first part right now between the banking system and the Fed. But actually the banking system and the economy are tightening, as you can see from this chart over here. So, and this is the money supply M2. M2 is the money when the banks lend to business, that liquidity is then deposited in other banks, then is relent again to other businesses, and this becomes money supply M2. What has happened to M2? M2 has been contracting quite sharply, as you can see here. You see here contracting quite sharply. Why? I said you before, the banking system doesn't feel comfortable lending to business. They are raising lending standards. So there is no liquidity in the system. It doesn't matter what the Fed does, interest or lowering interest rates. That's the important point that I'm trying to make. Because if the bank don't see an opportunity to make money, they are not lending, they are not extending credit, and therefore the liquidity in the economy is contracting. And this is bad news, because obviously the banks feel very uncomfortable in lending money to business. They know something is wrong out there, and they're being very careful. The time to be aggressive and excited is when this happens, when the money supply increases, because now banks are lending to business. But now it's coming exactly the opposite. Not only that, but the money supply is contracting. Never happened before. So what really this is saying, that as far as inflation is concerned, we might have not only low inflation, but quite likely deflation. Okay, this chart shows two things. One is the short-term interest rates, the 2-year treasuries, which is the blue line. And then it also shows the commodity price index, which is the blue line. Now, as you can see, I'm sorry, the other way around. The commodities is the orange line, and the 2-year yields is the blue line. Now you're saying the Fed, if you listen to the TV channel, business channel, the Fed controls interest rates. Well, how come then that both commodities and interest rates go exactly in the same way? Does that mean that the Federal Reserve controls also commodities? The point is business. You see, business, when business slows down because they see slower demand, they require less production. But requiring less production, what does it mean? They have to produce less, so you need fewer resources. Fewer resources means fewer raw material prices, because you need fewer commodities, and the price of commodities go down because there is less demand. On the other hand, there is also less financing because you don't need to borrow not only to buy commodities, but also to expand machinery or to require new machinery. So also interest rates go down because there is less demand for money. And then eventually, if things get really tough, then you will see employment going up because you don't need, in fact, already it's happening, and I showed in other videos, that employment really is beginning to contract in certain areas. So this is the important thing. You see how the two trends are exactly the same, because they are not, it's not the Fed that lowers interest rates and lowers commodity prices. It's business, less demand from business that sends prices down. And at some point, unemployment up. Okay, what this chart shows the trends of commodity prices, the orange line, and bond yields, which is the blue line. Now, again, why commodities and long-term interest rates have the same turning points, more or less. And again, it's what I said before. Business, when things are slowing down, require less short-term money for short-term operations, to manage short-term operation, but also is discouraged to make long-term investment. And since demand goes down, then of course also bond yields go down. And here you see the same pattern: commodities rising, and you see yields rising. Then you see commodities declining, and you see bond yields declining. And this is the relationship between interest rates and, if you wish, even commodities, between commodities and stock market. The business rises, then expands. At some point, inflation rises, interest rates rise, the business is overheating. There is inflation. Inflation slows down the demand for the goods. Business then retrenches, start cutting production, less borrowing, less raw materials, and then raw materials decline. And then finally they decline to a point where profits start rising again. Then they start increasing production. Again, production increasing. There is overheating. Overheating then recreates rising inflation, rising interest rates, because they have to keep plants operating at full capacity and pump as much goods as they can. Unfortunately, at some point, inflation causes demand to slow down. Profits start hurting. Business retrenches. Fewer raw material purchases. Less borrowing. Raw materials decline. Interest rates decline. Now they start making money again, and the cycle starts all over again. And this is what the cycle is. You see interest rates rising. At some point, earnings start coming down. The market reacts and start declining. Business retrenches until interest rates rise. At some point, profits start rising again, and then business improves. At some point, interest rates, when the economy overheats, interest rates and inflation rise. Then earnings start getting hurt. The market peaks, and then the economy goes down and interest rates decline. So, by the way, the peak, the average from the peak from interest, these two peaks could sometimes are almost at the same time. I just put it there because logically one follows the other, but they're almost close together. Instead, the peak on interest rates to the bottom of the stock market is roughly 20 months. and then the bottom of the stock market, which is when earnings start rising and the economy start picking up and so on, to the bottom of inflation and interest rates is another year and a half, 2 years. So this at the length. Where are we? Well, I think you know from what I said that interest rates are coming down clearly, and the market is at the same level of 2021. So it's not that basically is here. So I let you decide when the next bottom is going to be. I am the publisher, as I said, of the Peter Dark portfolio. You can get a copy, and it's free. You don't need credit cards. I also wrote a book that was McGraw Hill Education. Saw my website, saw what I was talking about, so they asked me and paid me to write the book, and it's really great. I'm really pleased by the kind of reviews I have on Amazon. You can check them out. Then I wrote 2 more books, and of course I'm on YouTube with my videos. Well, I want to thank you very, very much for following this video. I hope you find it interesting. Again, I'm trying to think out of the box more than anything else. If you think like everybody else, you will do what everybody else is doing. I have to ask you a big favor. If you subscribe, it's going to help me. I'm not going to make much money, but eventually I will. Okay, if you can subscribe, I would really appreciate it. Thank you very much for following this video, and please do keep in contact. So long, take care of yourself.